In today's video, we have a very successful gold market insider that's going to be breaking down his unusual predictions for gold mining stocks, and how to really not only make sense of these unprecedented times that we find ourselves in, but the best ways to prepare yourself. And that's Brett Richards. He is the CEO of Goldshore, which we will be talking about a little more shortly. So we want to welcome you to today's episode. I want to thank you for coming back again today. If you enjoyed today's episode, make sure you hit the like button on this video, subscribe, bell notifications, what notifies you for new episodes. You can give us a comment right there down below and let us know what you think of today's episode. And we will link the Goldshore website right there down below in the description. So, Brett, good to see you.
Jake, thanks for having me on.
Yeah, so we got introduced through our mutual friend, Sean Kuhn from Dolly Varden. And you and I were chatting, and I was blown away by just the level of experience you have in the mining industry. So before we kind of get into your macro thesis and whatnot, I was just hoping you could give everyone a little background on you and your history in the industry.
Sure. I've been in this space for around 36 years. I cut my teeth early on in the metals business and the steel business, and moved to Kinross in the 90s, and spent quite a bit of time with Kinross, living around the world, living in Russia and South America, and in the U.S. on various deals that we had done to acquire and properties. And the CEO and I left, and we founded a company called Katanga Mining in 2005, whereby we did our shareholders 86 times money from the original investment. And we sold 5 years later to Glencore once we got the mine up and running. It was in the DRC. And we sold for $1.8 billion. And since then, I have run other listed companies, Avocet PLC in the UK, a gold company that had assets in Malaysia, Indonesia, and West Africa. And also Midnight Sun Mining and Rocks Gold. And most recently, I've been working for private equity on a number of projects that we co-invest in. So I co-invest with a number of private equity firms. And a couple of years ago, I got turned on to Goldshore, and I said, this is an absolute winner. Given where I felt gold was going to go, given the kind of the macro environment that was leading up to last year, I felt that Goldshore was interesting enough, not only for me to invest in significantly, but I wanted to run it, and I wanted to see the trajectory of this company's success.
Beautiful. So before we get into kind of that macro, one of the cool things about very experienced executive like yourself is you guys seem to have projects all over the world. You said you lived all over the world. Where was the most interesting place you lived while you were working and building mines?
I think one of the most challenging, and I guess challenging and interesting can be interrelated in some cases, it was the DRC. The governance issues in the DRC are still quite prevalent, and I've been arrested in the DRC. I've been in a jail in the DRC for no reason other than not wanting to bribe the guy to get my passport stamped, and so very interesting. And been to Papua New Guinea and Indonesia and various parts of West Africa that are also very very interesting as well.
That sounds like a story from one of Doug Casey's novel series on speculation. So give us an idea of your macro view, right? Like you were, for lack of better terms, you were essentially retired from running mines and being involved directly in mining companies. And you said, given the macro environment that we now find ourselves in, and then coupled with the opportunities that you thought were very viable with Goldshore, you decided that you wanted to step back in the game. So what is that macro view that you have, and why was it attractive enough that you wanted to get back into the gold mining business?
Yeah, it's a great question, Jake. I was around in the real run up in the 80s, and I also was firsthand running gold mining companies from 2001 to 2012 in the last big bull run we had in gold. And there was a lot of things about both those big runs that were aligning to what's going on in the world today. But I think what we're seeing now is more of a perfect storm. We have the macro political situation, the geopolitical unrest that we see with major superpowers in this world. That creates tension, and it creates, it has created now supply chain issues. It has created a number of other kind of spin-off effects because of the Russia and Ukraine situation. And we have these other major superpowers kind of sitting by and watching. And these supply chain delays have compounded, and they affect CPI. They affect 5 or 6 lockdowns in Canada and the US. And then we had, variants that continued on. So for 3 years now, we've gone through the pandemic, and we're now entering kind of that hyperinflationary environment. And last year, I knew that we were going to kind of enter into this because of low interest rates and because the cost of goods was going up. We were going to enter into this big high interest, this high inflation period, and we didn't really feel it until January. Because I remember going to the Denver Gold Show, and I've told this story a couple of times, but I remember going to the Denver Gold Show, and Goldshore had just started. We'd started to trade on June the 4th of last year. September comes, the first major conference that people are going to be there at, and it was like a ghost town. I thought I got the date wrong, and yes, COVID played a bit of a part of that. But I look around and there was like nobody there. I watched Mark Bristow speak on stage, and there was 12 people in the audience, and I think half of them were with the Denver Gold Group. You walk down the hallway and there was no investors, and it really started to hit me. Yes, I get it. Maybe I called it a little early. I didn't call it wrong. I maybe called it a little early because the market was doing 20% last year in a number of asset classes. And gold was flat. It did its job in that kind of environment, but gold equities really got hammered. They were down 20%, 25%. So last year's story, nobody cared about. You could have a good story like Goldshore and nobody cared about it. And that really kind of rang true until kind of November and December. We saw a run up in gold price and then a pullback. We saw a run up in gold price and then it would pull back. But in January, we heard the first kind of I word, and that was inflation. We heard Q3 was 6.7%, 7% in the US CPI. And then we heard about December being 7%, and carried on in January. That inflationary situation made me believe that now you're going to see these asset classes that are highly affected by inflation because of transportation or fuel or oil or cost of goods or labor. All of those sectors, whether they're consumer products, consumer discretionary, to a lesser degree real estate, but certainly transportation, and to a lesser degree tech, but they're also affected. But you're going to see money roll out of those asset classes and go somewhere. And it was the flight to safety. And then the geopolitical tensions happened in February. And then everything kind of started kind of crescendo. But what happened was just when the asset classes were going to change and we're going to see this big rotation of capital come out. And I can talk about the 10-year treasury in the bond market, also 5% negative rate of return, which is not sustainable. You're going to see a rotation of capital come out of those asset classes. Where are they going to go? Well, in the 80s and 2000s, they came to precious metals. They came to gold. They came to gold equities. And we saw a really nice run up from 2001 of 250 gold all the way up to $1,900 gold in 2011. So we saw that really big run up, and gold equities followed suit, and gold equities are trading at a premium then. But today in February, we saw that big risk off because of the geopolitical situation. A lot of the funds just went completely risk off. And even though there's a number of other kind of macro social things like electrification and decarbonization and the push to get there, everything basically stopped in March. And nothing really happened with the gold price. Nothing really happened as the market was extremely volatile, up 900 points, down 700 points, up 600 points. There was a lot of volatility. We saw it in April. Now we saw that correction. So now I believe we're entering into this time of where all the planets are aligning. The war is going to work its way out. They're going to work a solution. It's not going to be a month. It's probably going to be 6 months, or it's going to be 9 months. But there has to be a solution for this. But we're going to wake up in June and we're going to see 10% inflation. And there's no other way to combat that loss of value than storage of wealth in gold and gold equities, because they're leveraged to gold price. And companies like ours who are going to double and triple and potentially more the resource base, it's a big leverage play to the gold price. So that's my view on the macro, and why I think we're entering this time now where there's going to be a fairly strong kind of movement into our sector.
I got first introduced to, really, of course, I'd heard that the underinvestment in commodities across the board to develop mines, but especially in precious metals, I'd heard it, but I wasn't sure to what degree it was serious and what degree to it was, some type of a marketing angle. And then I got introduced to the concept by David Garofalo, who has been on the show a lot. Of course, he's on the board at your company, Goldshore, but he really broke down firsthand to me exactly what's happened to the industry over the last while, and the depletion of resource bases and the necessity of these larger companies to find deposits that especially have been improved and developed upon. And when you and I met, that was one of the macro thesis that you explained to me as, first of all, why you wanted to step back into the industry, and more specifically, why you felt Goldshore could fit that market need. So can you break down that depletion of resources, and then also that kind of story behind Goldshore and where you're focusing in terms of market needs?
A great question. And there's a number of kind of angles here. I think, whether it's David or whether it's others in our industry, our industry has done a very, very poor job when it comes to sustainability or sustaining itself. We have to replace operating companies. So I'm not talking about Goldshore, but operating companies need to replace their reserves more than they actually produce. Otherwise, the model's not sustainable. And you just can't go out and do that through M&A. It takes boots on the ground, drill rigs in the ground. You need to find and create value. Newton's law, value, you can't add value to nothing. Something is drilling, exploration, and resources. And those resources end up getting proved up to reserves eventually. And the big companies have done it. They haven't done it well enough. But below that, nothing, our sector, our junior mining sector, is a bit ADD. They want to drill holes. They want to get the results in the market. They want to wave their arms, and they want to raise money, and they want this thing to go on forever. They don't do quality work. And I'm speaking generally, because there's a lot of companies that do very, very good quality work. But our reputation as junior mining, or junior mining's reputation, is that that's what they do. They just try and get the results out to raise money so that they can, flip it off to somewhere down the road. And I absolutely am completely against that philosophy, because it's not sustainable. You're not creating real sustainable value. Somewhere on the other end of that, somebody's a loser when somebody's a winner. You need to create incremental growth in size and scale and quality. And you need to be able to do it in such a fashion that the predictability and the reliability on that resource is high, very high. And, I go back to kind of NI 43 101, but this is beyond that. This is about creating a business that the viability of the business going into production is high and gets higher with time. And that takes the quality work you need to do along the way. Drilling holes, one thing. Finding a resource, one thing. You need to do extensive metallurgical test work to understand the liberation of the ore. You need to do extensive work on the ground in ESG. And it's not just a buzzword. It is reality. It's almost a technical term, because it's as important as the technical side of things, because permitting, social responsibility, ethical behavior, and how you deal with, and in our case in Canada, how we deal with our host communities and Indigenous communities, and those relationships are all extremely, extremely important. And other parts of the world too, where I've worked, where host communities are as well. So I think our sector has done a really poor job replacing those reserves to make it sustainable. So some of the companies that we see out there are actually going to decrease in value over time unless they change the trajectory in what they're doing technically on the ground and with their businesses. Otherwise, it's a declining profile to zero. And that's not a good investment model for our sector. So we have to get out there. We have to get out. The big guys have to go out there and replace reserves 20% higher than their production level every year.
Yeah, interesting. And when you really break that down, you can see how that compounding year over year with depressed prices for the last decade, which limit capital flow, those two things kind of create a perfect storm. So what's kind of the story behind Goldshore and what you got going on?
Yeah, so that's right. Because, back in I'll say the 2000s, 80s and 90s for sure. But even in the 2000s, I could go out and I could go to London, Switzerland, New York, Boston, Toronto, Vancouver, Texas, San Diego, San Francisco, maybe 8 or 9 cities in a roadshow, 2 weeks. And I would see 90% of my investors, because they're all major institutions in those major markets and major cities. And they played in our space. There were gold funds, there were specialty funds, there was precious metals funds, there was generalist funds, and there still are some of them. But our sector has kind of really flip-flopped. We don't have those big institutions anymore. So it really impacted that junior mining sector. As an extension of my last answer, when the big guys aren't replacing reserves, the smaller guys don't have the capital to be able to go out and do these things. So there's been a big void in our sector, even at the bottom end of the lead generation, of the generating of ideas, much like Goldshore, so that the big guys can pick up and turn them into big district scale mining companies. So because there's been very little exploration and development, we're 10 years behind the curve. And it's going to be very, very difficult to pick that up. It's going to affect commodity prices for sure. It's going to keep the demand. It's going to keep the supply issue. Going to keep prices up, and not artificially. They're up, and they're going to stay there. And it's why I take a view of gold trading between 1,800 and 2,200 for the foreseeable future. We're not going to pull back like we did in 2012 or like we did in 89, 90. We're not pulling back to $1,200, $1,100, $1,000, $800. There's always been a pullback in the cycle. We're not going to see that this time because of that. What's happened in the last 15, 20 years, specifically last 10, about not replacing the reserves and not being capital for the small junior miners and the exploration companies. Enter Goldshore. When I saw this opportunity, you get very, very few chances in your career to take something and do a 10-bagger with it. And I've been lucky. I've done one with, did a really large one with Katanga Mining, and did a 5-bagger with Avocet. But you get, when you see those projects, and mineral economics really distill in my brain quickly, I can quickly determine whether this project is viable, whether this project has the legs to make it to the finish line. And Goldshore ticked all of those boxes for me for a number of reasons. Big land package, big historical resource. Okay, means upside. But outside of the resource, there was all kinds of mineralization result that proved similar to the resource. And nobody really kind of hung it all together, again, because there was no capital tenure and the money on kind of follow up and do much with the property, but just keep it in compliance. So I saw the kind of resource size and scale opportunity. We're also on the Trans-Canada Highway. We have 10-cent kilowatt hour power. We have major infrastructure in and around us, natural gas, water, 4-lane highway, a rail spur almost on our site. It may well be on our site. We haven't figured that out yet, but there's a rail spur. 2 major railroads, CN and CP, run right by our project. We're 130 kilometers out of a major city. You got contractors, equipment, people. You can run a mining company here where people can go home and see their families on weekends. So this, to me, is a viable project, technically It's extremely opportunistic and there's lots of upside. But when we tick those boxes, is this project going to go into production? If we were in northern Baffin Island, where you fly in everything and fly in diesel power, you better have a resource that is 10 times better than what we have, because of the cost of doing it, and the project viability is just going to stretch it out over time. This could be done. We could start working on this project next year, the year after, and it could be in production in 5 years with the right capital backing and the right partner. This could be in small scale production in 5 years. That's viable to me. That's why I saw this opportunity. And we put a big program together, both a geophysical survey and a 100,000 meter drill program to prove this. We got 4 million ounces. We think we're a tier 1 asset. We think we can get this to 10 million ounces, and we can start and demonstrate that graphically in our presentation and graphically in our 3D model. We can show people what we saw all along, and it's not really rocket science. So I think I'm eating my own food here. I'm drinking my own Kool-Aid. We are doing this to a quality that is acceptable to any major mining company, whether it's the data wash, the data base, whether it's the type of work we do, the technical other work that junior mining companies don't do. We're doing extensive metallurgical test work. We are doing an environmental baseline study to help speed up and shorten the period to permitting. We are doing all of this because mining companies need to do all of this. You don't want to have a mine that has this much potential and it go 10 years before it goes into production. Speed to market is critical. Speed to market for investors is absolutely critical. We're going to be valued from ounces in the ground to cash flow per share. And there's a transition getting there from being an explorer developer to being an actual constructor and getting this into first gold and getting this into production. There's a period where we'll start and make that change, and we need to do this as quickly as possible. It's why we're doing all the work on the front end. So I am living to my own argument about doing things to a quality and doing things to a standard I think is acceptable. And the capital markets have believed in us. We've raised $50 million in 15 months because they listen to this, and they really do understand the viability of this. Now, has it been reflected in our share price? I'm not going to lose sleep over that, because we're in a very, very, as I described it earlier, a bit of a funky market. We're in this macro political is vibrating very strongly. The macroeconomic is vibrating very strongly. The macro social is also vibrating very strongly. And we just need to get through our program. The market will catch up to us in due course when all of these things start to settle down.
Beautiful. So what type of conversations in a market like this does Barrick, does a Newmont, does an Agnico, what type of conversations are they, first of all, having internally, given this environment you painted, that there's such a necessity to replenish resources? In addition, what type of conversations, if any, are they having with exploration and development companies with known resources? Are they saying, hey, get going because we need help? I mean, what's the type of conversations that are happening there?
I think strategically, this is where leadership really, really shines in mining companies, in any company. But we have a situation where we're entering into one of the most robust, I'll say, 10-year periods in commodity cycles in the last 75 or 80 years. So how do the majors prepare for that? And I'm not so much talking about base metals. I'm talking about precious and or bulks. I'm talking about base metals that are affecting electrification of vehicles, copper, aluminum, lead, zinc, vanadium, manganese, etc., and nickel, cobalt, but also gold, silver. And so those companies are entering into strategic discussions now and saying, how do we grow? I don't want to buy our growth. I want a combination of organic growth and inorganic growth, because the speed at which I need to grow is faster than we can actually deploy people on the ground. And I'm sure the multi-operational companies the top 10 gold mining companies in the world are looking at just that. And some of them have said, we're going to look outside of our comfort zone. We're going to start and look in tier 3 jurisdictions. We're going to start and look in places that haven't, we haven't tread for some time, simply because we need the tonnage, we need the ounces, we need the reserves. And we're also going to look and focus on tier 1 jurisdictions and help accelerate that. I think the major mining companies need to start working with juniors and help them along and help them with that development curve, oversee and help them with capital and give them the push. Let them be autonomous, but help them get to where they want to be. Agnico do a great job of this. Osisko do this, and Barrick do this, and Newmont do this, and to a lesser degree, there are others that do these kind of partnerships. Yamana, B2, they do these partnerships, and they do them well. And I think there just has to be more of that, because our sector needs that help. There is a compounding kind of the issues that we have. There's a real deficit of talent in our business. And when you've got old guys like me still in the business, there needs to be resurgence of 30 and 35-year-old guys coming up through the sector. And there's a gap. The millennials really didn't focus on natural resources as career options in the 2000s. So now we're not seeing the graduates to retirees ratio being positive. It's actually negative. For every 3 guys that are retiring, we're only seeing one person come into the industry. So you've got all of these challenges, and the majors are having those discussions internally. It's about people, it's about projects, and they're willing to go to new locations. But yeah, they're going to focus on jurisdictions like the US and Canada all day long. So I think we're going to see more development in areas like where we are. And nobody's cared about where we are for the last 25 or 30 years, because the Shabandawang Greenstone Belt is low-grade material. It's a 1.2, 19 grams or 17 grams or 6 grams underground. It is low grade. So it's bulk tonnage. It takes a lot of capital. It takes a lot of effort. But these projects, and Detour Detour Lake is a very good example. These projects are highly geared to the gold price, because you're moving so much tonnage and so much volume, and your production profile is quite large. I don't quote me, but Detour is going to do somewhere in the order of 750,000 ounces this year, probably $1.2 billion in free cash flow just from that operational alone. These things can move the needle, and they can move them quickly.
That's an amazing stat for every one new person coming in, 3 are retiring. Seems like there's a theme across the board in mining for depletion of various types of assets, whether it's reserves in the ground or whether it's talent. So where is Goldshore traded?
Today, we're kind of trading in and around that 50 cent mark in Canada, less than the US, but around the $60 million market cap. Last year we started the year and we ended the year with the exact same market cap, and we're about where we started, around that $65 million market cap, plus or minus a day's trading. So we haven't really done anything yet, and I think our market hasn't done anything yet. There's been some winners, there's been some spikes, there's been some M&A. We saw Kinross take Great Bear out. We saw Newcrest take Pretium. We saw Agnico merge with Kirkland Lake. We've seen some big deals, and we've seen some big, I'll say, some consolidation, but also the majors taking that first step about replacing reserves or bringing in new resources into their portfolio. But let's face it, Kinross also had to sell its Russian operations. It also just sold Chirano, which is in Ghana. So it's kind of retooling itself, kind of a complete re-inventory. And I think they're going to be extremely interested in looking for other Great Bear-sized resources, Detour-sized resources, because they need to kind of replace their production profile. If they don't, the value to their shareholders will decrease. And Barrick's under a lot of pressure, and Newmont's under a lot of pressure to do the exact same thing. And there are very few resources in this world that are tier one, and very few in tier one jurisdictions. There is no junior mining company today that's a tier one 10 million ounce gold company. Now, there's a lot on the cusp of that, and I'd like to think that we're on the cusp of that. So there's probably a dozen who are in that kind of 4 to 7 million, 8 million ounce still drilling, and some of them, are very viable. I think those are the cream of the crop. They're the ones that are going to be most attractive to the big guys coming in and saying, you know what, you've done a good job here. We're willing to pay your shareholders a premium to continue on here, and that's what I see happening in the market. And the premium will be dictated by the quality of work that you've done, obviously the size of the resource that you've increased to, but it'll also be something. It'll also be connected to the quality of work you do, and I think that's been very important all along. I used to look at projects and you'd say, we have to go and redo all of this. It's good, but it could be great, and we need to redo it to make it great. And we're trying to enter greatness by the quality of work we do. And my VP of Exploration, Pete Flindell, he's worked with me for almost 20 years now, and he worked for a major in his first 14, 15 years of his career. He's worked for majors, and he and I have kind of we ran a mid-tier. I ran a mid-tier company. He was my VPX, and we know how to build these businesses in a proper way.
So you were saying at the beginning of the interview that you've been through a few of these cycles of volatility of the bear market, of the bull market. Let's end with a little bit of advice from someone like yourself who's really succeeded through what can be a challenging or volatile sector to be in. What's the best advice to an investor watching today to handle this bull market, especially considering the macro environment that we find ourselves in?
So, the advice that I would have is you have to be very close to world events. You have to understand what's going on in this world, and you have to take a view of how it is going to affect things in the future. And to our great hockey star of years gone past, Wayne Gretzky, he said, "I'd always go to where the puck's going to be, not where it is." And that you have to think that way in investing. You have to understand the impact of what is going on around the world today, how it's going to impact, not just a year from now or 2 years from now, but what is this going to look like 5 years from now? Everybody has taken a really, really harsh view of mining over the years, and that's a generalization, but there's been a lot of sticks poked at mining over the years. And then there was a jump on climate change. And yes, mining has traditionally been very, very carbon positive. But there was the decarbonization initiative, and there's also the electrification of vehicles initiative. How do people think we're going to get there without mining? We're actually going to have to increase mining by percentages way greater than what we're doing today to achieve the decarbonization goals in the world by 2030 and 2040 in some countries. And the electrification of vehicles, where you need battery minerals like nickel and cobalt and manganese and lithium, and these minerals are not abundant, but they're available, and the ramp up to complete the electrification process. And there's always going to be some sort of fuel-based, carbon-based vehicles out there. But these technologies, these emerging kind of disruptive technologies, they change the way you should be investing today for 5 years from now. People need to have a longer view of things and let value be created, not trading with ADHD and trading on changing markets. Trying to be at your own algorithm just doesn't work. You'll lose every time. I invest in businesses that are solid, that will stand the test of time, and that I think have fundamentally kind of sound principles and good management. You always invest in the people that are running these businesses. So electrification of vehicles, I have a real tough time investing in something like Tesla, given the valuation that it was trading at. And so all these things, I think, what we're doing in the mining space, oil and gas, and other carbon businesses, what we're doing in that space, how it's going to affect electrification and the geopolitical pullback. And I'm going to talk about something a little bit new, going from almost protectionism. We're starting to see it, and we're starting to see critical mineral strategy in the U.S., critical mineral strategy in other parts of the world. China has been doing this for a long time. We're going to hoard all the minerals that's going to take to electrify so we can protect ourselves. That is a bit of a different step than we've seen globally over the past 5 or 6 years as we've tried to make these steps towards decarbonization and impacts on climate change. So I think I think the advice is quite simple. You really have to see where the puck's going and invest in things that are going to be value created. Never forget Newton's law. You just can't create something from nothing. Matter cannot be created from nothing. Value can be created by boots on the ground, by great management, by great fundamentals, and by executing. So those are the types of businesses people need to be thinking about. Because they will stand the test of time. I don't have a stomach for up 20%, down 20%, up 20%, down 15%, on a weekly basis, on a monthly basis. I don't have the stomach for that. I want to see something that's $20 today go to $100 in 5 years. And I'm comfortable with that. And that's why I invested in Goldshore. It's why I wanted to manage Goldshore, is because I know that we can create multiples of our value today if we even start to trade at where gold companies were trading in the 80s, where they were trading in the 2000s, and where they should be trading today. They're not trading where they are today because of all these fundamental and unsustainable approaches that the mining companies have taken over the years, but also in this market. So I think Goldshore is one of those rare opportunities where I not only can create good sustainable value, but I can do multiples of it for our shareholders.
Beautiful. We want to thank you for joining today, Brett Richards. We want to thank you for watching today's episode. I will link the Goldshore website right there down below. They are traded on the TSX and the OTC as well. So we'll go ahead and link their website. If you enjoyed today's episode, make sure you hit the subscribe, bell notification. We're going to be following that trend, skating where the puck's going to be. Many insiders in the market have demonstrated to us that we're headed into a precarious situation in the mining industry through supply chain disruptions. As Brett said, countries now hoarding it, coupled with underinvestment. So I'm going to enjoy watching that trend unfold and getting those updates from you, Brett.
Thanks, Jake. Thanks for having me on, and thanks for all your viewers.
Absolutely. So we will see you on the next episode. We want to thank you for watching, and let us know your comments and questions that you have down below for Brett to feature on a future episode. And we will see you next time.